It sounds like in some ways this is similar, in some ways it's different, right? So you have a single tenant who's coming in here and they have this lease. So they're leasing out this space, they're using it for manufacturing or storage or whatever it is. So is it similar to the multifamily model in that effect, in that, every month you're collecting the rent? Are there any other risks or other considerations to think about?
Yeah, I think an easy way to kind of get to those questions you just asked is to tell the acquisition story. Like, how does a deal like this kind of come together? So we actually acquire most of our properties through a mechanism called sale leaseback. And sale leaseback is effectively when you have a manufacturing company that also owns their own real estate. What usually happens is that company will have been started from scratch by the founders, sometimes 40, 50 years ago. It's grown profitably year over year, just very kind of organic growth, really expanding their market share in whatever niche that they do. The owners typically look for an exit, right? They hit retirement age, they're looking to sell their company and kind of cash out on this baby that they built over time. So they will oftentimes sell to a private equity group. So private equity groups, there's a lot of sizes and shapes of those. They will usually sell to a smaller manufacturing focused private equity group who will be building a portfolio of manufacturing companies, often that kind of can support each other in some way. And they will acquire that building. Now, these PE groups, they are laser focused on building value in the operating company of that company they just built. What they are less interested in is owning real estate. So they say, hey, we can get a better internal ROI by reinvesting as much capital as we can into the company we just bought. We are less interested in owning bricks and mortar and roofs of the real estate. So what they do is they sell us the real estate and then take those proceeds and reinvest it into the operating company they just bought. So now they are either paying down corporate debt, they are investing in new capital improvements like new manufacturing lines, they're adding headcount, they're really doing all the things that private equity groups are excellent to just juice the growth of this new company they just bought. So what happens on a sale leaseback, we effectively give them a bunch of cash that was tied up in the building. We became the owners. And at the same time, we pre-negotiate a long-term, typically 15 to 20-year lease for them to sign. And they are becoming, going from an owner position to a tenant. So they are effectively staying in place. No one's actually moving. It's all a paper transaction. But now they are a renter and paying a predetermined amount of rent as opposed to being an owner in that situation.
Mm-hmm.
And are they responsible for the property taxes, or are you guys? Because I know just enough to not really know what I'm really talking about when it comes to like triple net leases. I looked into it. It was like one of the asset classes I was looking at when I first got into real estate, as you mentioned earlier on. There's so much to look at. And I had looked at that because I was like, this sounds magnificent. That was like the thing I was like going to do, because just in terms of like cash flow, guaranteed cash flow and low risk and all that kind of stuff. Talk to us a little bit about that. I'm just curious how that compares to retail triple net leases.
Yeah, absolutely. So you have, on one side, you have a gross lease, right? Gross lease means effectively the landlord pays for everything. The renter simply pays the rent and has no further obligations. And then as certain responsibilities go from landlord to tenant, those are what's referred to as the three nets, the triple nets. So the first is going to be taxes. So your property taxes. If your tenant pays for those, it's a single net lease. If they also take on insurance, and that'll be a predetermined amount of insurance coverage, premiums, deductibles, et cetera. Now it's a double net lease. And the third is going to be operating expenses or utilities. So effectively, your water, your electric, your, changing out light bulbs, repainting, and that piece is your third net. And what's interesting is on a single tenant property, we actually expand that definition to what we call absolute triple net. And absolute simply means now we're looking at what I say fence line to fence line. So not only are they covering those three things, but let's say you need a new roof. They pay for the roof. Let's say you need to, redo the pavement outside. They're paying for it. Let's say landscaping needs to be done. They pay for it. Really 100% of the ownership expenses tied to that real estate all stay with that tenant in that transaction based on the terms of that lease you signed with them.
Wow. So from a risk standpoint for an investor, it's pretty low, it seems like, right? Because what could possibly come up? Property taxes, if they change or if they go higher or lower or whatever, then they're responsible for that. If insurance goes up or down, they're responsible for that. So when you, on the onset of the deal, really knowing what you're getting yourself into in terms of projected cash flow and whatnot, and the overall, performance of the deal is pretty solid, right? Or is there something that I'm missing?
No, that's spot on. So especially during the hold period, your cash flow that's coming in from those rents is extremely predictable. So you have effectively, as an investment group, we have effectively removed about 100% of the operational risks to our cash flow, right? So like you said, the tax assessor comes, doubles our tax assessment, doesn't matter. It's on the tenant, right? If the insurance company comes and goes, hey, we're doubling your premiums, no big deal. It's on the tenant. So all those issues that could come up to really disrupt your pro forma business planned investment model for cash, really, you're insulated at a very high level from anything like that. And so what's great is I can look an investor in the eye and say, I can tell you almost to the cent what kind of cash flow we'll be making, and I can distribute even like 3 years from now. And very few other investments in the commercial real estate space can you do that.